You saw the price move, but you did not measure the force behind it. That is why the breakout failed and your capital was erased. The uninformed trader sees only two dimensions on a chart: price, which is the vertical axis, and time, which is the horizontal axis. They believe their task is to guess the future of the price line. They are wrong. Their focus is misplaced, and their methods are those of a gambler at a roulette wheel. They are destined for financial ruin because they are blind to the third crucial dimension of the market. That dimension is volume. The market is a perfect mathematical and geometric machine. It is not an erratic beast driven by news and emotion, but a clockwork mechanism governed by immutable laws. These laws are expressions of vibration, of cycles within cycles, of wheels within wheels. Price is what happens. Time is when it happens. But volume is the measure of force, the energy, the conviction behind the event. Without understanding volume, you are merely observing the hands of the clock without any comprehension of the gears and springs that drive them. Think of it this way. An army can advance 1 mile. This is the price movement. It can do so in 1 day. This is the time factor. But did it advance with a force of 100 soldiers or 100,000? The volume tells you the strength of the army. A breakout to a new high on the price chart is meaningless, and in fact dangerous if it is accomplished by a small, weak force. It is a feint, a trap for the unwary. Conversely, a major offensive, a true change in trend, must be accompanied by a powerful force, a significant increase in volume. Volume confirms time. It validates the turning of a cycle. It provides the energy for a price movement to become a sustained trend rather than a momentary fluctuation. The law of vibration dictates that every stock and every commodity has its own unique rate of vibration. These vibrations manifest as cycles in time and corresponding swings in price. When a market reaches a critical time point, a major anniversary date, the culmination of a 90-day or a 144-day cycle, it is poised for a change in trend. It is at a harmonic crossroads. But the change requires energy. Volume is the measure of that energy. If a major time cycle is due to complete and a top is expected, we must see a corresponding signature in the volume. If the cycle is to reverse, the energy that drove the old trend must be exhausted, and the energy for the new trend must begin to build. Let us construct a mental image. Picture a bull market in corn futures that has been ascending for over a year. It has followed a predictable geometric path, perhaps respecting a 1-0-2 angle, meaning it advances 1 unit of price for every 2 units of time. The trend is established and the public has grown comfortable with its slow, steady rise. Now a major time cycle is approaching its end. Let us say it is the anniversary of the last major low. The price begins to accelerate, breaking out of its orderly geometric channel. The uninformed see this acceleration as a sign of strength. They rush to buy, fearing they will miss the next great move. The price makes a new high and then another. But if you were to measure the force, you would see a critical divergence. As the price makes these final, frantic new highs, the volume begins to decrease. With each new peak in price, the corresponding bar on the volume chart is lower than the last. What does this tell us? It tells us that the army is thinning out, the conviction is fading. The smart money, the informed operators who understand these laws, are not participating in this final ascent. They are quietly distributing their holdings to the public, who are buying on emotion and hope. The trend is becoming exhausted. The vibration is weakening. The price is rising on inertia alone, and it cannot be sustained. When the time cycle completes, the reversal will be swift and severe because there is no underlying force to support the high price level. The low volume was the confirmation that the time for a top had arrived. It was not a guess. It was a mathematical reading. Now, let us reverse the scenario. Imagine a stock, a blue-chip industrial that has been in a bear market. It has been declining for 270 days, a significant cycle. The public is despondent. The news is filled with pessimism. The price is making new lows, but observe the chart in your mind. The volume on this decline is light, anemic. There is no conviction, no panic. The market is simply drifting lower as interest wanes. Then, as we approach the 270-day time point, something changes. On one particular day, the price plunges sharply, falling through a previous support level. But this time, the volume explodes. It is a massive spike, perhaps 5 or 10 times the average daily volume of the preceding weeks. What is happening here? The uninformed see the sharp price drop and the high volume, and they panic. They believe it is the beginning of a collapse. They sell their remaining shares at any price just to get out. But they are misreading the tape. This is not the start of a decline, it is the end. This is the capitulation. This is the final washout of all the weak holders. The immense volume represents the transfer of shares from the panicked public into the hands of the informed operators who have been patiently waiting for this exact moment in time. They know the time cycle is complete. They see the high volume not as a sign of selling pressure, but as a sign that all the potential selling has been exhausted in one climactic event. The high volume confirms the time cycle bottom. The force of the decline has been spent. From this point, with the selling exhausted, the path of least resistance is up. To trade with this knowledge, you must abandon guesswork and adopt a set of strict, unbending rules. These are not suggestions. They are the operating principles for engaging with the market as a scientific endeavor. Rule number 1. A breakout from a trading range or a move to a new high or low is only to be trusted if it is accompanied by a significant increase in volume. Visualize a horizontal rectangle on your chart, a period of consolidation. If the price breaks above the top line of that rectangle, the volume must be higher than the average volume within the rectangle. If it is not, the breakout is suspect. It is likely a false move designed to trap the impatient. This is the confirmation rule. Rule number 2. In a protracted uptrend, watch for the exhaustion signal. This occurs when the price makes a new high, but the volume on that day or week is significantly lower than the volume on the previous major high. This is a clear geometric and energetic divergence. It is a warning that the motive force is dissipating. The trend is old and tired. The informed trader does not buy here. Instead, he prepares for a change in trend. The same rule applies in reverse at a bottom. A new low on very light volume indicates that the selling pressure is exhausted and the market is not following through to the downside. Mathematical precision requires the correct textbook. Truth of the stock tape lays out the foundation for determining the trend of the market by analyzing the tape and the charts. It is not enough to read it. You must study it. The link to this edition is provided in the description below. Rule number 3. Understand the nature of churning volume. This occurs when the market experiences extremely high volume for several days or weeks, yet the price makes little to no progress in either direction. The price is confined to a narrow range. The uninformed see this as a market that is doing nothing. The informed see it as a colossal battle. At a market top, this is called distribution. The informed operators are selling vast quantities of their holdings, but they do it skillfully, feeding it into the market to meet the public's buying demand without causing the price to drop. The high volume without upward price progress is the evidence of this massive selling. The reverse is true at a bottom. High volume with no further price decline is accumulation. The smart money is absorbing all the selling from the weak hands. When you see this signature, you know a major move is being prepared. The direction of the subsequent breakout from this range is almost always the direction of the next major trend. Rule number 4. Respect the quiet market. Periods of extremely low volume, often called the doldrums, are not a time for complacency. They are a sign that the market is coiling, building potential energy like a compressed spring. The public loses interest. The speculators move on to more active markets. This is when the market is setting up for its next major campaign. A market that sleeps on low volume will awaken with a violent move. Your task is not to guess the direction, but to be prepared. Watch for the first significant price move on a burst of volume. That will signal the direction and the start of the new cycle. Now, one must consider the scenarios where these signals appear to fail. There are no failures in the law, only misinterpretations by the student. For instance, what of a blow-off top? This is a market top that occurs on a final climactic spike of extreme volume. Does this not contradict the rule of declining volume at a top? No. It confirms it from a different angle. A standard exhaustion top with declining volume is the result of a slow and methodical distribution by professionals. A blow-off top is the result of a public mania. It is the final parabolic phase of a bull market where greed overtakes all reason. The public, who were hesitant for months, now throw all caution to the wind and buy in a frenzy. This creates an enormous spike in volume at the very peak. However, this is not a sign of strength. It is the signature of a panic, a buying panic. It represents the final exhaustion of all available buying power in one single explosive event. Once every potential buyer has bought, there is no one left to push the price higher. The reversal from such a top is typically the most violent and rapid of all. So you see, whether the volume declines into a top or explodes into a top, it is still confirming that the time cycle has reached its termination point by signaling the complete exhaustion of the trend's energy. What if you act on a volume signal and the market moves against you? For example, you see a breakout above a resistance level on high volume. You buy. The next day, the price reverses and falls back below the breakout point. The gambler would hold on, hoping the market will turn in their favor. This is the path to the destruction of capital. The market mathematician knows that while the rules provide a high probability of success, they are not infallible. There can be larger, longer-term time cycles at work that override the shorter-term signals. This is why the most important rule of all is the use of a stop-loss order. Your stop-loss is your mathematical fail-safe. When you enter a trade based on a time and volume signal, you must simultaneously determine the price point at which your analysis is proven incorrect. This is not a matter of opinion. It is a geometric point. If you buy a breakout above a former top, your stop-loss must be placed just below that top. If the price returns to that level, the breakout has failed. The signal was invalid in this instance, and you must exit the position with a small, calculated loss. To remain in a losing trade is to substitute hope for mathematics. Hope has no place in this business. A small loss is the tuition you pay for a market education. Allowing it to become a large loss is an unforgivable failure of discipline. Let us apply this three-dimensional thinking to a commodity like cotton. Imagine cotton has formed a major bottom in May at a price of 80 cents. The time is May. The price is 80. The volume at this low was climactic, signaling a turn. The market then begins a slow, steady advance. It rises for 90 days, arriving in August. The price reaches 95 cents. It is a new high for the move. But the volume on this day is only 1/3 of the volume seen at the May bottom. What is this telling you? It is telling you that the advance from the low lacks force. It is a rally in a bear market, not the beginning of a new bull market. The time factor of 90 days is significant, but the lack of volume confirmation warns that this cycle is weak and likely to fail. The informed trader would use this rally to establish short positions in anticipation of a move back down to test the May lows, or even break them. The uninformed trader, seeing only the new price high, would buy. When the market turns down, they would be trapped. They saw only one dimension. You must see all three: price, time, and the force that binds them: volume. In conclusion, you must cease to be a one-dimensional observer of the market. You must elevate your analysis. The chart is not a flat line. It is a three-dimensional object moving through time. Price tells you the level. Time tells you the cycle. Volume tells you the commitment, the energy, the truth behind the move. High volume confirms the end of one cycle and the beginning of another at major time points. Low volume warns of a lack of force and a potential for failure. Study the relationship between these three elements. Do not act on a price signal alone. Do not act on a time cycle alone. Wait for the confirmation where all three align. When a significant time cycle is due and price reaches a key geometric level, and volume confirms the move with a decisive increase in force, only then do you have a high probability opportunity. This requires patience. It requires discipline. It requires you to do the work, to study the charts of the past to understand the laws that will govern the future. The market will reward your study and your discipline. It will ruthlessly punish your guesses, your hopes, and your ignorance. The choice is yours. You can continue to gamble, or you can begin to operate as a market mathematician. The laws are there for you to learn. The clock is ticking.